Let's talk a little bit about the difference between an adjustable rate mortgage or an ARM and a fixed rate mortgage or a fixed mortgage. Obviously, the simple answer is adjustable mortgages have the potential for the interest rate to be adjusted. That doesn't quite tell the whole story, of course. In general, an adjustable mortgage is at a lower interest rate. You're taking advantage of the fact that you're allowing the bank to adjust the mortgage and adjust the interest rate as national interest rates change. The advantage to the bank is they can set a margin above prime lending, let's say, and then as prime lending changes, your interest rate on your payment or on your mortgage will change, and therefore your payment will change. Typically, you can sometimes get a 1 percentage point maybe difference lower on any given day of adjustable rate versus a fixed rate. Now, but here's where a fixed rate beats adjustable rate. When the interest is going to go up in the next, say, 5 years, a fixed rate may make a ton of sense because it locks in at today's rates, granted a little bit higher than an adjustable rate, but as interest goes up, that fixed rate stays the same, whether you have it locked in for 5, 7, 10, 15, or 30 years, depending on your mortgage. And so what you're doing is you're setting a stable, consistent interest rate for the life of the loan, ideally, and then not having to worry about changes in the market, changing the interest rate, thereby changing your payment, which affects your cash flow. So it's a game that each time you look at a deal, you have to look at the pros and cons of both. In general, I like fixed rate loans. Adjustable rates tend to be a little bit too aggressive for me, my taste, and I think that you're setting yourself up for a cash flow problem, especially if interest rate spikes. Also, when interest rates are low, you can get a great fixed rate, and if the only way you can get a deal done is by the slight savings in margin of an adjustable rate mortgage over a fixed rate, you're probably paying too much for your property, and you're setting yourself up to really lose some money when that interest rate goes up after a year or 2 years or whatever. So in general, I prefer a fixed rate. Run your numbers, run your analysis, but really look at that property and that package and see how it cash flows either way, and then make your best guess.